part of the compelling business case for sustainability initiatives is about the risks to the company if it didn't do the project. So looking at the three justifications that frame the business case for sustainability, this time we're going to be talking about mitigating risks that are on the horizon that could otherwise do damage to the organization if it's not ready for them. And again, looking at the full superset of potential benefits for any sustainability initiative, we're addressing the one at the bottom, which is really a condensed line item. There are lots of risks underneath that, and we're going to be fleshing those out a little bit in this video. We should start by acknowledging that many risks are simply the flip side of the benefit. So if we're talking about saving energy, if we didn't do the project, it could be that the cost of energy would go up, and therefore you may have an offsetting risk or a cost of risk associated with that. Same with materials, same with water, same with waste. So the flip side of the benefits very often make up a significant part of the monetization of the risks. There are some risks, though, that I just want to make sure that we highlight, and these are 6 of them that may not be intuitively obvious as associated with some of the other benefits, and which may or should be taken into account in some situations. Let's start with the risks to revenue that have to do with access to markets. So for example, if part of your customer base is located in Europe, there are regulations in Europe that may be a bit challenging for you if you can't meet them. So things such as restrictions on hazardous substances, the WE regulations, the REACH regulations, and so on, these could actually be inhibitors to your ability to market and sell your products in some jurisdictions. So this is an example of Sony's efforts quite a while ago, but they were trying to get their entire European shipment of PlayStation games into the European Union in time for Christmas. And at the border, they found that, or the European officials found, that there was an excess of cadmium in the cables. They delayed the shipment, and that's what cost the company a significant amount of money because they had to then repair all of that, and by that time the Christmas season had passed. So what we're talking about is that the regulations that are in place in some markets may be challenging for the company to meet if it's not being sustainable, responsible, careful about the components of the products that it's marketing in those markets. In a sense, business-to-business operations also are markets. So if you're marketing to Walmart, they are one of the companies that you are selling your products to. They are in the process of making sure that the attributes of the suppliers as well as the products that they're buying from them meet their standards on sustainability. So they have an index that they are using to screen their suppliers and their products to ensure that they are environmentally and in some cases socially responsible. So we're talking here about factors which are being used now in the procurement process that can differentiate sustainable companies from others and may be important to your marketing activities. And just a reminder, there are risks of fines for not complying to regulations in whatever jurisdiction you are operating in. So if you look at the risks of inaction on sustainability to the profit of the company, one of the biggies is regulations and the reputation associated with being able to meet those regulations. And in fact, that's deemed as one of the biggest risks of not paying attention to environmental and social aspects of your operation. So there are fines, lots of examples of companies that have been fined. Whether or not those are serious enough fines to get them to change their behavior is another question, but there are significant amounts of money which are being levied as fines against companies that have violated the regulations in the jurisdictions in which they're operating. And then there are risks of fines, bills, costs of externalities, and they've been called externalities because they have been external to the company and companies haven't had to worry about them. Like this. But there are examples of companies who are starting to size what the cost would be if they were responsible for the damage that they have done to the environment and society through either their own operations or the operations of their supply chains. So in 2011, for example, PUMA, the footwear company, put out the first ever environmental profit and loss statement, and they gave themselves a bill for a virtual bill, but a bill for the damage that they had done to the environment through their operations and the operations of their supply chain. And that bill amounted to $190 million of damage to ecosystems, which was a significant part of their profit that year if they'd actually had a real bill levied against them. And what you see here is the way in which that damage is being contributed to by various factors. So damage from the way in which they're using water, from greenhouse gases, from land use, etc. So it's a significant acknowledgement that there are quite significant areas of harm that a company can do directly or indirectly to the environment from its operations. And in fact, the next slide shows that indirect part. This is kind of a stark acknowledgement that only 6% of that damage is coming from PUMA's own operations. Some of it's coming from their direct suppliers, some of it's coming from their suppliers' suppliers, some of it's coming from their third-tier suppliers, but the majority of it is coming from their fourth-tier suppliers. That is, the people who rear the cattle, whose lead that they use in their shoes, the rubber plantations, the cotton farming, the petroleum production, and other materials. So this is a very surprising for many companies realization that a lot of the indirect damage that they're doing is significantly higher in impact than their own operations. So when companies put out sustainability reports and they tell us all how they're doing, they're usually telling us how they're doing on their own operations. This was a very significant change in that, where PUMA went public with the fact that a lot of the impacts that they're having on the environment are external to their operations. And now other companies are going public on this. This is Novo Nordisk's environmental profit and loss statement. And again, you can see that a significant amount of the impact that they're having is in their suppliers area. Same kinds of things that they're looking at. So if we were to take a look at the cost of the harm that's being done to natural capital and actually size it and give companies a bill for it, it would have a significant impact on the profit of those organizations. So depending on the time horizon of your analysis, those bills for externalities may be worth including in your business case for sustainability initiatives that help mitigate those risks. And then we get into risks from climate change. This is a biggie, and there are so many different risks. Let's just take a quick look at some of them. First, let's acknowledge that every year the World Economic Forum puts out a report called Global Risks, and this year, of course, is Global Risks Report 2018. And what they do is they slice and dice about 30 risks that are on the horizon that can do damage to companies within the next 10 years or economies within the next 10 years. And they show the level of impact of those risks and the likelihood of them happening within the next 10 years. And you'll notice that there are some green ones up here, green being environmental, which include failure of climate change and climate change mitigation and adaptation and extreme weather events. So that is positioning these kinds of risks that are on the horizon as being significant risks, not so much to polar bears, but to companies and to economies. So what we're looking at here is an acknowledgement by economists that these deserve attention by companies. Of course, the companies that are most impacted by these severe weather events are insurance companies. Their losses, insured losses, are significantly higher than they used to be, but the overall losses, including uninsured losses, very, very high damages. So the physical damages are certainly worth looking at. And in fact, if you take a look at the risks, you'll notice that there are risks that have to do with water scarcity, water quality, energy security, transportation risks, flood, droughts, food security, natural resource availability, and so on. Lots of different risks. And as climate change starts to pick up, and if a company is operating in various locations, it deserves attention to these things just to see what the potential impact might be if these things were actually to happen. So if we were to look at the categories of climate change risks, they could fall into these 5 major categories. The ones we've been talking about so far are physical risks, which of course can have financial implications and legal implications. And some of these could be reputational as well as the ability to compete effectively in the marketplace. So let's just take a look at a couple of these a little bit. This is a pretty comprehensive list of climate change risks. There are about 8 of them. There's physical damage. We've talked about that. Supply insecurity. We've talked a little bit about that. However, there are some others that are a little bit more indirect, like reputation with customers could be impacted if they sense that the company is a contributor to this. Threat to the market value, which is the value of their stock. Loss of people that walk away from the company if they think the company is not doing enough on this front. Access to markets, regulatory price on carbon, litigation, even lawsuits for their pollution. So that's a pretty healthy list and may deserve some quantification in the business case for the sustainability initiative that you are about to undertake or at least propose. And there are a couple of other risks that deserve attention, especially if you are a publicly traded company. So risks to the market value of the company are worth looking at. This report shows that the risk to investors could be very significant as we start to see the global temperature rise above limits that climate scientists have said are actually quite dangerous, and even an estimate of what the damage might be to market value if it got up to 6 degrees above pre-industrial levels. Actually, I don't know how many of us will be around if it gets up to 6 degrees above centigrade, 6 degrees centigrade above what it was before the Industrial Revolution. There'll be at least this damage and maybe some others that are more personal. And there's also some evidence that it's not only the damage to the value of the stock, but also to the earnings. So climate change is becoming something which deserves consideration by investors who are in it for the short term as well as for the long term. Worth considering. And finally, let's look at this risk to access to capital. That is the availability of lenders and investors who want to put money into your company. One of the things that's really concerning these investors is that there is a lack of analysis of the impact of carbon pricing on investments. And what a coalition of 347 global institutional investors are asking for, and they manage a lot of assets, is a stable, reliable, and economically meaningful carbon pricing. So these people are asking for a price to be put on carbon to develop a transition plan to phase out subsidies for fossil fuels, if not fossil fuels themselves. So these are huge investors that are really encouraging more disclosure around what's going on in companies around carbon and energy dependencies that they have on fossil fuels so that they can make a more informed investment. That has been captured most recently by the Task Force on Climate-Related Financial Disclosures, affectionately known as the TCFD, which should be at the top. And what this says is that companies should voluntarily disclose climate-related financial disclosures so that they provide decision-useful information to lenders, insurers, and investors. These are very reputable people that headed this up. So what you have down here is a picture of Mark Carney, who's in charge of the Bank of England. Bloomberg was also part of this as well. And what they're saying is they need to know what the exposure is of a company to climate change so that they can decide whether or not they are going to invest their money in those companies. So this is the investment and lending community the providers of capital, saying, we need to know more than you're telling us on this, so you need to disclose it. So the risk is if they don't, they may have a tough time getting capital from these folks. So what we've looked at is a bunch of risks associated with inaction on the sustainability front. There are some ways in which you can estimate those risks that are the same as they are for some of the other benefits, especially looking at what the figures are that the folks who look after risk assessment scenario planning in your company may have, and experience of other folks, and being conservative in your estimates, but making sure that you do due diligence on what these risks might be and the way in which the project that you are suggesting may be able to mitigate those risks. It's an important part of the business case for sustainability.